The second thing that you look at is investment acumen, or what in the oil and gas business is called the recycle ratio, which is to say you quantify the track record of the management team at redeploying the capital that they get from the payments that they receive from the mining companies into new investments. In other words, is the company growing, or is it at least maintaining its revenue base? And is it doing so efficiently? If you look, as an example, at the recycle ratio,
get ready for a unique perspective from a true legend in the world of investments. Rick Rule isn't just being cautious, he's doubling down on the commodities space. In this video, we're taking an exciting journey into Rick's mind as he unveils his bold strategy to aggressively invest in gold, silver, uranium, energy, and a host of other commodities. Why, you ask? Because Rick Rule believes that with the right time horizon, the world of commodities could deliver some of the most spectacular returns in the years ahead. So, let's dive deep into this strategic insight and discover why the world of commodities is about to get very, very interesting.
I think in the very near term, it's a challenging circumstance for most investors and speculators. I think we're beginning to see the delayed impact of higher interest rates around the world. I think, too, people continue to be nervous about the war in the Ukraine and newly concerned about circumstances in the Middle East. Two, there's a lot of political and social instability in the world. And there's a malaise in capital markets also as a consequence of higher interest rates. I don't need to tell anybody who owns long bonds about the impact of higher interest rates on the prices for the long bonds and disintermediation of the bond market. I think we're beginning to see a spillover of that into equity markets, particularly the larger equity markets, where rising interest rates reduce the capitalized value of income streams from dividends. All of those have conspired to produce difficult equity markets. Now, perversely, I love difficult equity markets. To me, a bear market is a sale. And what I'm seeing is that companies that I have wanted to buy for substantial periods of time, or at least stocks I've wanted to buy for substantial periods of time, but I've been unable to buy as a consequence of low prices, have corrected. So for me, as usual, the worst of times becomes the best of times. For people who don't have my patience, or for people who don't do the work to establish value, but rather practice the got a hunch, bet a bunch technique, these are and will continue to be tough times. I'm not exercising caution. I'm attempting to place capital. I note that the last time we visited, we spent a substantial time talking about uranium. And I said that we would pass into uranium bull market when the pace of Japanese restarts accelerated. That happened, and we're in a uranium bull market. Uranium is outperforming other commodities. I would use this not so much as an I told you so, but rather to reacquaint your audience with the fact that commodities that are out of favor are the commodities that you buy. One really, truly hated commodity right now, one that's disappointed investors for at least 3 years, is silver. So I'm starting to look for silver stocks. I like them when nobody else loves them. That isn't to say that you exit the uranium stocks yet. I think that uranium has at least a year to go in a bull market. If you're there, be right, sit tight. If you're not there, if you're coming into the space, you need to exercise some caution now. It's not a no-brainer, like it was the last time you and I talked. As to the broader question around commodities, I continue to be attracted to precious metals because I believe that the policy response to an economic malaise is highly inflationary. I see government deficits everywhere, even as I see it being more difficult to service those deficits with higher interest rates. I think the way around the political promises that have been made is to inflate away the net present value of the government's obligations, which is to say inflation. I saw it happen early in my career in the 70s, and I think I'm going to see it happen again. So I'm attracted both to precious metals and to precious metals equities, although some patience will be required. I'm attracted, too, to industrial materials, although I suspect that the next year will be challenging in the industrial materials market. I don't think a Chinese rebound has happened anywhere near as quickly as people would have preferred. And I think that you are seeing the delayed punch to the economy affected by higher interest rates, as well as caution in continental Europe as a consequence of war, and newly established caution around the disputes in Israel and Palestine. I believe longer term, however, that the market for industrial materials will return and will return in spades. I think that's true because I think we've underinvested in productive capacity for a very long time. And as world population growth continues, and as the material ascent of humankind continues, that the ability to produce that we currently have around several materials will be insufficient to meet current, let alone future demand. I continue too, Jesse, as I was in our last interview, to be particularly bullish around fossil fuels, oil, gas, coal, things like that. The big thinkers in the world, the Justin Trudeau's, the Joe Bidens, my favorite energy physicist, Greta Thunberg, people like that to tell you that the era of fossil fuels is over. I would note, Jesse, for your listeners, that humankind has now spent almost $5 trillion US in 40 years on alternative energies, and we've reduced the market share of fossil fuels from a high of 82% all the way down to 81%. $5 trillion has reduced fossil fuels market share by 1%. What does that mean? Oil and gas, stronger for longer. Coal, stronger for longer. Uranium, stronger for longer. Note, I'm not against alternative energies. I want to put them in their place. I'll add them to my portfolio when they're economic. But compared to, oil and gas and coal, the place in the sun will continue to be enjoyed, I think, by fossil fuels to the benefit of investors. Lobo has to serve an audience that's impatient. Lobo has to perform on a monthly basis. Lobo has to serve an audience that pays him a fairly reasonable amount of money for what amounts to trading advice. I'm not a trader. I'm an investor. I'm a speculator. It's odd, Jesse, and I've said this to Lobo. By the way, I have huge respect for Lobo, who's also a personal friend. It's odd that as old as I am, as little time as I have left on Earth, I've become very patient. I think in 5-year terms. The consequence of what Lobo has to do is that he has to think in quarterly terms. I think he has to do what he has to do, and I have to do what I have to do. I love circumstances where I think there's a high probability that I'm right, but the uncertainty revolves around time. I phrase it as asking a question where the answer begins with when, not if. I prefer when questions. Lobo, at present, given what he does for a living, can't afford when questions. I have a phrase I like to use that says inevitable but not necessarily imminent. I like things that are absolutely cheap. I like things that are relatively cheap. And the way you get them is to buy asset classes that are out of favor, particularly with impatient competitors. Well, they're much easier to construct net present values for, because you don't have to take into account cost inflation, as an example. You don't have to take into account wage settlements. You don't have to take into account sustaining capital investments or new project investments. These are purely an economic interest, either in the deposit itself or in the product stream for the deposit, which means that you construct a matrix of commodity prices that you expect in the future. I use the forward strip as an example. And then I use a discount to the forward strip, and I use a premium to the forward strip so that I can construct a matrix of price expectations. And then I construct models around the expected output of the mine in question and attempt to arrive at a rough net present value. If the company is selling at a reasonable discount to what I think it's worth, I have a buy. If, by contrast, the company, as it often happens, is selling at a large premium to the net present value of those free cash flows, I sell. The second thing that you look at is investment acumen, or what in the oil and gas business is called the recycle ratio, which is to say you quantify the track record of the management team at redeploying the capital that they get from the payments that they receive from the mining companies into new investments. In other words, is the company growing, or is it at least maintaining its revenue base? And is it doing so efficiently? If you look, as an example, at the recycle ratio around Franco-Nevada going back 30 years, not only did these guys start life with an incredible asset in the Carlin Trend in the United States, where they paid $2 million for an asset that's generated $1 billion in royalty revenues, but they've done a wonderful job reinvesting that $1 billion to build what is truly the most formidable mineral royalties portfolio in the world. So you look at net present value, and then you look at what I call recycle ratio to give you some sense of what the asset is worth and what the probability is of the growth of that asset in the future.
Thank you for joining us on this exhilarating journey through the world of commodities with the insightful Rick Rule. If you found this video as compelling as we did, don't forget to like and subscribe for more thought-provoking discussions and expert insights. As you venture forward in your investment journey, remember that the world of commodities holds remarkable potential for those with the right perspective and the patience to see it through. Stay informed, stay agile, and may your investments in commodities shine bright in the years to come. Until next time, take care and invest wisely.